Welcome once again to your financial reporting class. I want us to continue working on our property plants and equipment questions, as well as the other, standards that relate to uh, tangible and current assets. So before us is a question on tangible and current assets. Foster has built a new factory incurring the following costs. Okay, so we have got all those costs there. The question is, what will be the total amount to be capitalized in the factory cost, or in respect to the factory rather. So our job here really is just to isolate capital expenditure from revenue expenditure. Land is capital expenditure. Materials for self-constructed assets is to be included in the capital expenditure. Labor is to be included in capital expenditure labor cost. Architects fees, that is also taken. Surveyors fees, that is also taken. Site overheads, these are incidental costs that are supposed to be taken. Apportioned administrative overheads. Okay, now this one we don't have to take because these are administration expenses. Testing of fire alarms, we take that one. Business rates we do not take because of course that is a normal revenue expenditure. So we're going to take everything except for 12 and a 150 there. Let us do some work there. So the total, let me just remove that, push it where it belongs. Okay, total is, that's the amount there. Okay, then less administration overheads. Okay, I think so 150. Then we also less rates. I think I saw a 12. I don't. Okay, that's what we have there. Okay, so when we sum up all these amounts, we are getting that figure. Hope that you can see it as well there. So of course our answer in this case is B. Okay, let us progress to the next question. So the next question is coming out of borrowing costs. We are told carried Ways company has the following bank loans outstanding at the year end. X8, okay, 9% loan, principal is 15, excuse me, and then we have got 11%, the principal is 24. C company began construction of a qualifying asset on 1st April 20X8 and withdrew funds 6 million on that date to fund construction. On 1st August 20X8, in addition, 2 million was withdrawn for the same purpose. Okay, calculate the borrowing costs that can be capitalized in respect of this project for the year ended 31st December 20X8. Okay, so our job here is to initially get what we call the average interest rate. Okay, let me right, so let us have a go at that, see what is happening there. We are running with average interest rate. Again, this is not supposed to be very difficult to handle. I'm going to suggest that we do the following. When I look at your options there, I'm seeing some figures. So let us just write some things there. Say 9% goes with 15% and 11% goes with 24. So say 9 multiplied by 9% goes with 15 million rather. So 15 million divided by the sum of the two principals, which is a 39. Okay, so this is 9%. Then we add a 24, not 24 rather, but check again. We've got about 11%. Yes, 11%. Multiply that by 24 divided by 39 for you to get your average interest rate. Okay, so when I do the summation, I think that we are going to have something close to what I'm going to find here. 9%, 9%. Okay, so 9% is as good as 0.9. Okay, 0.09. Then you multiply that by, going to multiply that by 15 divided by 39. Yes, 39. Close that brackets. Then you say plus, yes, 11% multiplied by open brackets. You've got 24 divided by 39. I'm going to close the brackets as well. Okay, so that is what I'm having there. Okay, so now I think my next job is to apply this that interest on my funds taken out. Borrowing cost will be equal to, so I'm going to have full figures on the other side. For the 6th, we have got amounts taken out, which includes $6 million, as well as a 2 million. Okay, let's do some bit of work. So there we go, 6 million. Okay, multiply that by that figure there. Then I multiply that by, let us turn back the question and see the rules here. Courage began construction of a qualifying asset on 1st April and withdrew 6 million on that date for construction. So we observe that the months that are falling between 1st April and 31st December is 10, not 9, 10. So you say this multiplied by 10 divided by 12. Okay, how much are we getting? I'm having that figure there. All right, let's also do the same for the other amount there. So this one was withdrawn, the 2 million was withdrawn on 1st August. Between 1st August and 31st December, we have got about 5 months. So again, I go is equal to 2 million multiplied by our average rate, and then we multiply that, of course, by 5 divided by 12. I'm getting that. So when I sum up these two amounts, I'm getting about 596 there. Okay. Let us try to just round off these figures so that we have our full amounts. Let me just do that. Okay, so that's what I'm having there. Okay, right. Okay, so this is the most accurate figure. I think I know that in your suggested solutions, perhaps there could have been an error that could have been committed, but I think we are closest to A, which I suppose is the answer there. Let us progress to the next question. This is question 26. It says Leclerc company borrowed 2.4 million to finance the building of a factory construction. Is expected to take 2 years. The loan was drawn down on 1st January 20X9 and work began on 1st March X9. All right. Again, we're dealing with about 10 months there. If we're going to go all the way to December, then we are told that 1 million of the loan was not utilized until 1st July 20X9. So Leclerc was able to invest it until needed. Leclerc company is paying 8% loan, 8% interest rather on the loan, and they can invest surplus funds at about 6%. Calculate the borrowing cost. So this again is the question coming out of borrowing cost, and seek again to help us to see that if the company can invest any surplus funds at an interest rate, then that will reduce our borrowing costs. But we must pay attention to the active periods. Okay, so let's progress. Let's see what is happening. Okay, say question 3 on there. We have got borrowing costs again. What is happening? We were able to get some money at a specific interest rate. So again, our borrowing cost will look as follows. Right, so let us calculate initially the borrowing costs. So over 10 months, again, we say 6 million. Multiplied by multiplied by 2.4. No, is that 6 million rather, or 2.4? It's supposed to be 2.4 multiplied by 8%. Then you multiply that further by 12 over 10 over 12. That's what we have there. Multiplied by That's what we have there. Nice. So now let us deal with the investment income. On the x-axis, 1 million that was reinvested at 6%, if I'm not mistaken. So this one was reinvested. From the question, we are told we reinvested this amount since we didn't need it until 1st July. Now, if you calculate the number of months between 1st March and 1st July, you'll be discovering that we are running with about 4 months. So we shall see close brackets 4 divided by a 12. Try to see what is happening there. So equal sign 1 million multiplied by what we have there is that amount. Good. This is supposed to be a minus. So let's do the work. That is the amount that we expect to find on the other side. So 140. Okay. So A is the answer there. Let us progress to the next question, 27. Question 27. Question says, which of the following would be recognized as an investment property under IAS 40 investment properties? In the consolidated financial statements of Beautyco, A says the property intended for sale in the ordinary course of doing business, that's stock. Then B says the property being constructed by a customer, that is falling under IFRS for a customer rather. Property constructed for a customer, that is falling under IFRS 15. Then we have got property held by Beautyco rather as a right of use asset leased out under a 6-month lease. That's falling under IFRS 16 leases. And then we've got D, a property owned by Beautyco leased out to the subsidiary. Okay, so this one, you know, could be okay. I think this one we need to be a bit careful. This one could be treated as owner occupied. Okay, interesting. Yes. Okay, I'd like to go for C because I think D, from the context of group accounts, if the subsidiary occupies one of the properties for Beautyco, then that's owner occupied. So C is the best option. Says the property held by Beautyco as a right of use asset and leased out under a 6 months lease. So C is the best option, I believe. We can counter check that. Okay, let us go to the next question. Identify whether the following statements is or are true in accordance with IAS 40 investment properties. The first one says, following initial recognition, investment property can be held at either cost or fair value. That's true. So we just have to click that place there in our exams. If an investment property is held at fair value, this must be applied to all the entity's investment properties. That is also true. Then we are told an investment property is initially measured at cost. I agree with that, including transaction costs. Well, we can take that one. Then says a gain or loss arising from a change in the fair value of an investment property should be recognized in liquidation surplus. This is false because that goes gain or loss that goes to statement of profit or loss. So I'd like to end there. I want to challenge you to do the rest of the questions. Let me hear from you. Thank you very much.